In this video, we're going to talk about Aterian, trading under the ticker symbol ATER. Aterian is a consumer products company. It has its brand of home and kitchen appliances, beauty products, and consumer electronics. Recently, the company has been the center of a lot of attention and speculations between those who want to short sell the company and those who want to short squeeze the short sellers. The reason behind this current dynamic is because on one hand, short sellers want to push the stock price lower, since the company is incurring operating losses. They can do this by borrowing shares, sell the shares at the market rate, and recover them later on, and to make money with the difference between when they sold and when they recovered their positions. The trading volume of Aterian has recently been 4.1 million shares, compared to an average volume of 3.4 million shares. Over the previous 52-week period, its price has fluctuated between $3.04 and $48.99. The market cap of Aterian is currently at $195.4 million, compared to an enterprise value of $377 million. The difference between the market cap and its enterprise value is the premium or discount the financial market is willing to allocate to the company, based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many of those companies. It is especially true for growth-type companies that one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company can generate more profit or to have more growth than other competitions because it has a good management, it has stronger brand recognition, and it has a bigger following online. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, since the market cap is lower than the enterprise value, which is the value the market gives to its assets when the debts are paid off. In comparison to this historical price fluctuation, the stock is 7.3% higher than the 1-month low, 7.3% higher than the 3-month low, and 20.1% higher than the 52-week low. In terms of options market, which gives hint on where the market sentiment thinks that the stock price is going to head toward, the implied volatility is 167.8% compared to a historical volatility of 86.8%. The put-call volume ratio is currently at 0.08. The most recent volume of options traded has been 5.2 thousand contracts within a day compared to the 30-day average volume of 3.9 thousand contracts. In terms of open interest, the most recent volume of open interest has been 51.6 thousand contracts compared to the 30-day average of 63.6 thousand contracts. Regarding the shareholder structure, institutional shareholders hold 25.4% of its outstanding shares. The biggest shareholders include Hudson Bay Capital, BlackRock, and Vanguard. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or to view it as a short-term volatility trade. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term holding. Of course, there are exceptions from what I said above. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of the positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 27.2% of the total float and 46.4% of the dark pool transactions and 46.6% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 2 sell, 8 neutral, and 1 buy, with an overall tendency of neutral. The moving averages are showing 14 sell, 1 neutral, and 0 buy, with an overall tendency of strong sell. In terms of pivot points, which are levels of support and resistance, the support levels are $2.46, $3.75, and for the resistance levels, they are $5.34, $5.83, and $6.62. Looking at the stock price of Aterian over the past few sessions and weeks, it seems that the share price has been stabilizing after the significant volatilities downward. The appeal of holding Aterian stock is determined by the likelihood of the stock being short squeezed by those who want to push the stock upward against the short sellers. And so far, it seems like their effort has been under significant downward pressure ever since September of 2021. My opinion on the company is that it should remain on your watch list. Fundamentally, it is a very hard sell to go against a potentially massive volume from retail traders, in which case the short position would suffer losses that may be infinite in theory. In other words, we should definitely wait and see where the stock price is going to land, as we haven't seen the end of the tunnel about this stock yet. Keep in mind that the bottom of the stock so far has been $3.12, and that the current stock price is approaching that region. We should see whether the stock will go below that region when it gets near it. My recommendation is to make sure that your exposure of Aterian remains below 1% of your portfolio, but to keep an eye out for any potential support in sight. A realistic profit target would be in multiples of the cost basis if the short squeeze succeeds, which may not happen just yet. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks when shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.